Someone just bet $780 million that silver is about to crash. But here's what they're not telling you. Every single time the big banks have made a move this aggressive, the opposite happened. The price exploded. Retail investors got crushed, and the institutions walked away with billions. This isn't speculation. This is documented market manipulation happening right now in real time. And if you own silver or you're thinking about buying it, what happens in the next few weeks could either make you a fortune or wipe you out. Stay with me, because what I'm about to show you is how the game is actually played and how you can avoid becoming the victim. Welcome to Financial Freedom Desk, the only channel where we expose the market manipulation that Wall Street doesn't want you to see. If you're tired of getting played by institutions and want to understand how the money really moves, hit that subscribe button right now. Smash that like button, because this video is going to pull back the curtain on one of the biggest silver plays happening right now. And trust me, mainstream financial media isn't going to tell you this story. Let's dive in. So let's start with the facts. In the past 2 weeks, major institutional players, we're talking bullion banks, hedge funds, and commercial traders, have loaded up $780 million worth of short positions on silver. That's not a typo, $780 million betting that silver prices will fall. Now, if you're not familiar with what a short position is, let me break it down quickly. When you short something, you're betting that the price will go down. If silver is trading at $30 an ounce and you short it, you're hoping it drops to $25 so you can pocket the difference. But here's the catch. If the price goes up instead, you lose money. And unlike buying an asset where your maximum loss is what you paid, with shorting, your losses can be unlimited. If silver goes to $40, $50, or $100, you're bleeding money the entire way up. So why would these institutions risk $780 million on a bet that silver is going down? That's the question. And the answer is going to tell us everything we need to know about what's really happening in this market. Here's what the mainstream narrative is going to tell you. They're going to say these institutions are simply hedging. They're protecting themselves against risk. They have long positions elsewhere, and they're just balancing their books. It's normal market activity, nothing to see here. But if you've been following the silver market for any length of time, you know that's not the whole story. Not even close. Let me take you back in time, because this isn't the first time we've seen this movie. In fact, this is the same playbook that's been run on the silver market for decades. In 2008, JPMorgan Chase accumulated a massive short position in silver. At the same time, they were buying physical silver hand over fist. They were shorting paper silver on the COMEX exchange while stockpiling the actual metal in their vaults. What does that tell you? It tells you they weren't betting silver would go down. They were manipulating the price down so they could buy the physical metal cheaper. Between 2008 and 2020, JPMorgan reportedly accumulated over 1 billion ounces of physical silver. That's 1 billion with a B. At the same time, they were consistently one of the largest short sellers on the COMEX futures market. They were literally shorting paper contracts to suppress the price while buying up the real metal at artificially low prices. And here's the kicker. They got caught. In 2020, JPMorgan was fined $920 million by the Department of Justice and the Commodity Futures Trading Commission for manipulating precious metals markets, including silver. They admitted to using spoofing tactics, placing fake orders to manipulate prices for nearly a decade. Did that stop the manipulation? No, it just made them more careful about how they do it. Fast forward to January 2021. Remember the Reddit Wall Street Bets silver squeeze? Retail investors, fed up with what they saw as blatant manipulation, tried to squeeze the silver market by buying up physical silver and call options. For a brief moment, it looked like it might work. Silver spiked from $25 to nearly $30 in a matter of days. Premiums on physical silver coins and bars exploded. Dealers ran out of inventory. But then, mysteriously, the price got hammered back down. Margin requirements on silver futures were suddenly raised, making it more expensive to maintain long positions. The price action became extremely volatile, designed to shake out retail traders, and within a few weeks, silver was back below $25. Who benefited from that price crash? The institutions who were short, who got hurt, retail investors who bought in at the top. This is the pattern, and it's happening again right now. Now let me explain how this manipulation actually works, because once you understand the mechanics, you'll see it everywhere. The COMEX is the primary exchange where silver futures contracts are traded. A futures contract is essentially a promise to deliver a certain amount of silver at a future date. Each contract represents 5,000 ounces of silver. Here's the thing. Most of these contracts never result in actual delivery. They're cash settled. Traders are just speculating on the price movement. They buy contracts, ride the price up or down, and then close the position for a profit or loss. No physical silver ever changes hands. But the price discovered on the COMEX, the price of these paper contracts, is what determines the global spot price of silver. Even though only a tiny fraction of contracts result in actual delivery, the paper market sets the price for the physical metal. This creates an opportunity for manipulation. If you're a large bank with deep pockets, you can dump massive sell orders on the COMEX, short positions, and drive the paper price down. This scares retail investors, it triggers stop losses, it creates selling pressure. The price drops. But here's what the institutions know that retail doesn't. The paper price and the physical price can diverge. You can drive the paper price down on the COMEX while the physical market remains tight. Dealers run low on inventory, premiums increase, but the official spot price based on COMEX trading shows silver is falling. This is how they trap retail investors. They short the paper market, crash the price, shake out weak hands, and then when physical supply gets tight enough, they cover their shorts and ride the price back up. Rinse and repeat. And right now, with $780 million in fresh shorts, they're setting up the trap again. So let's talk about what's happening right now, because this is where it gets really interesting. First, look at the fundamentals. Silver demand is at near record highs. Industrial demand for solar panels, electronics, EVs, medical applications is growing. Investment demand remains strong as people look for inflation hedges. Meanwhile, silver mine production is essentially flat. New silver mines take years to bring online. The supply-demand fundamentals are bullish. Second, look at physical inventory. Registered silver in COMEX vaults, the silver that's actually available for delivery, has been declining. We're talking about the lowest levels in years. When the Wall Street silver movement started buying physical in 2021, it drained inventory. Some of that inventory has been replenished, but we're still well below historical norms. Third, look at the gold to silver ratio. Historically, silver trades at about 15-to-1 versus gold. That means if gold is $1,500, silver should be around $100. Right now, gold is hovering around $2,600 to $2,700 per ounce. Silver is trading around $32 to $33. That's roughly an 82-to-1 ratio. Silver is historically cheap relative to gold. Fourth, look at industrial stockpiles. Unlike gold, which is primarily a monetary metal, silver is heavily used in industry. And industries don't like to hold large inventories. It ties up capital. So when industrial users need silver, they buy it. If there's a supply disruption or price spike, there's no massive strategic stockpile to draw from, the market is relatively thin. All of these factors point to a market that should be moving higher. Yet we've just seen $780 million in short positions loaded onto the market. Why? Here's my read on what's happening. The institutions see the same fundamentals we do. They know silver is undervalued. They know physical supply is tight, but they also know that before silver can rally significantly, they need to shake out the weak hands. They need to trap retail investors who are leveraged with options or futures contracts. They need to create selling pressure and panic. So they load up on shorts, they drive the paper price down, they trigger stop losses, they create a capitulation event. Retail investors who bought silver at $32 or $33 see it drop to $28 or $29 and panic sell. Options expire worthless. Leveraged traders get margin calls. And then, when the smoke clears and the weak hands are out, the institutions cover their shorts at a profit, flip long, and ride the real move higher. This is the trap, and if you don't understand how it works, you become the exit liquidity. Now here's where this gets interesting for you as an investor. If this analysis is correct, if the institutions are setting a bear trap, then the right move is to do the opposite of what they want you to do. They want you to panic when the price drops. They want you to sell your physical silver when you see red on your screen. Don't. They want you to chase the price down with short positions of your own. So definitely don't. Instead, the contrarian play is to use their manipulation against them. If they're artificially suppressing the paper price to shake out weak hands, that creates a buying opportunity for those who understand the game. But, and this is critical, you have to play this correctly, don't use leverage. Don't buy options that expire in a few weeks. Don't try to time the exact bottom. If you're going to play the contrarian side of this trade, you do it with physical silver or with positions that give you time to be right. Here's the thing about physical silver. They can manipulate the paper price all they want, but they can't print physical metal. You buy an ounce of silver, you own an ounce of silver. No counterparty risk, no expiration date, no margin calls. And if the thesis is correct, if they're setting a bear trap before a real rally, then buying physical during the manipulation becomes one of the best risk-reward opportunities you'll get. Now, I'm not giving you financial advice. I'm not telling you to buy or sell anything. I'm showing you how the game is played so you can make your own informed decisions. But if you're going to be in the silver market, you need to understand that you're not just trading against other retail investors. You're trading against institutions with billions of dollars, access to leverage, and a documented history of market manipulation. So if you're going to navigate this, here are the signs you need to watch. These will tell you whether the trap is working or whether it's about to snap shut on the institutions themselves. First, watch the open interest on COMEX futures. If open interest starts declining sharply, that means contracts are being closed. That's often a sign that shorts are starting to cover. When shorts cover, they have to buy contracts to close their positions. That creates buying pressure and the price moves up. Second, watch physical premiums. If the paper price drops, but the premiums on physical silver coins and bars stay elevated or increase, that's a massive red flag. It means the paper and physical markets are diverging. The paper price might say silver is $28, but if you can't buy a coin for less than $35, then the real market price isn't $28. Third, watch the commercial traders' positions in the Commitment of Traders report. This report, published weekly by the CFTC, shows the positions of different categories of traders. Commercial traders are typically the institutions, the bullion banks, and when they flip from net short to net long, that's often a signal that they've finished accumulating and are ready for the price to move up. Fourth, watch gold's behavior. Silver often follows gold with leverage, meaning it moves in the same direction but with bigger percentage swings. If gold starts breaking to new highs while silver lags, that actually strengthens the bull case for silver because it means the gold to silver ratio is expanding even further, which is historically unsustainable. Fifth, watch for coordinated media narratives. If you start seeing mainstream financial media publish articles about why silver is a bad investment, why the bull case is dead, why you should sell, that's often a contrarian signal. The institutions don't spend money on media campaigns unless they have a reason, and that reason is usually to convince you to do what they want. Now let's zoom out and talk about the bigger picture, because this $780 million short position isn't happening in a vacuum. We're in a global environment of massive debt, currency debasement, and increasing geopolitical tension. Central banks are buying gold at record rates. Countries are moving away from dollar dependence. The entire monetary system is showing cracks. In that environment, precious metals, gold and silver, are monetary insurance. They're the assets you hold when you don't trust the system. And silver in particular has unique characteristics. It's both a monetary metal and an industrial metal. It's far more volatile than gold, which creates both risk and opportunity. The institutions know this. That's why they want to control the silver market. If silver were to break free and rally significantly, it would signal to the world that the monetary system is in trouble. It would validate the concerns of gold bugs, preppers, and anyone who's skeptical of fiat currency. That's not a narrative the establishment wants. So they manipulate, they suppress, they set traps, and every few years they let a little steam out of the pressure cooker by allowing a controlled rally. But they never let it truly run. Until one day, maybe, they lose control. And when they do, the move could be explosive. So how do you protect yourself in this environment? A few principles. Don't use leverage. If you believe in silver long-term, tone physical or unleveraged positions that can't get margin, called, or stopped out. Don't try to trade the manipulation. The institutions have better information, more capital, and the ability to move markets. Trying to out-trade them is a losing game for retail investors. Think in years, not weeks. If you're buying silver as monetary insurance or because you believe in the long-term supply-demand story, then short-term price manipulation shouldn't matter. In fact, it should be welcomed as a buying opportunity. Diversify. They just loaded $780 million in silver shorts. The trap is set, but the question is, who's trapping whom? Are they trapping retail investors, or are they about to trap themselves by shorting into a market where physical supply is tight and demand is growing? Time will tell, but now you understand the game, and that understanding is your edge. This is Financial Freedom Desk, where we expose the manipulation and give you the tools to navigate it. If this opened your eyes, share it right now. This is information people need to see before they get caught in the trap. Drop a comment. Are you buying this dip or staying on the sidelines? What's your silver strategy? I read every comment and I want to know your take. Subscribe to Financial Freedom Desk for more analysis that Wall Street doesn't want you to see. Stay informed, stay prepared, stay free.